There's no doubt we've seen a softening in Chinese interest in Australian capital assets, being driven primarily by Chinese government capital controls. What we are seeing though is continued strong interest from Singapore in particular and South Korea in terms of our regional markets, but also North America and Europe. With the pullback of the big four banks from debt lending into the real estate investment space, we've seen a lot of our offshore clients sourcing their debt offshore from local banks in their home markets, but we're also seeing a really significant growth in debt providers within the Australian market. More recently, we've seen a lot more fund-through models. So there's been significant competition pursuing the existing stock in the Australian marketplace. The fund-through model allows developers to access cheaper debt funding, but also to have a guaranteed end buyer on the development. And on the buy side, it gives people access to assets that they might not otherwise be able to compete for in an open competitive process. There's no doubt we're seeing a fundamental shift in what our shopping centres look like and what they're designed for. In new shopping centre developments and redevelopments, we're seeing much more of an end user social aspect to it. Rather than it being a shopping precinct, it's becoming a social hub for the community in which the shopping centre is located. Much more outdoor dining, much more of a food and entertainment offer than it is just a fashion specialty retailing offer. Everybody who's involved in real estate knows it's a cyclical business. For me, it's a fascinating strategic piece or time in our market for buyers and investors to be deciding which part of the cycle are they investing in, or are they waiting for a softening and the buying opportunities that will come when this market does inevitably soften from the highs that we're seeing at the moment.